We obviously had an extreme sell-off in late February and March, and this has been followed by an equally extreme rally in April, May, and to a lesser extent, June. From where markets are now, we think a lot could happen. There's potential for markets to continue to rally if we see good economic growth continue to improve, but there's also potential for another sell-off, especially if COVID infection rates continue to rise. Under the surface, there's a lot's happening in markets, with investors favouring big tech stocks, even though their valuations are very high. Bond and cash rates are very low. Central banks' intervention is at levels we've never seen before. The current environment means there's some really interesting investment opportunities out there, but some places to avoid as well. The rally since March has really been driven by a small number of stocks, what are known as the FANGs, or the FANGMs if you include Microsoft. Apple, Microsoft, Amazon, they're great companies, but investor sentiment and what we're calling the fear of missing out has really pushed them to very high valuation. Some of this is justified, given the increasing demand on their products and services as we all work from home or shop online. But as always, it comes back to what's in the price. And we believe this part of the market is currently priced in a way that we think is unsustainable and carries risks that are really unrewarded at this point in time. The question we've been asking is, how sustainable is the rally? We think that the probabilities of the FANGs being able to continue to lead the market higher are getting lower. Moving higher will really require new leaders, and we believe this will eventually come in the areas we've been favouring. Energy, financials, the UK and emerging markets are all interesting opportunities that investors have avoided because they see a lot of risk in these areas. We, in fact, think a lot of the risk in these areas is actually already in the price. So only a small amount of good news can mean that we see a big lift in investor perceptions as fundamentals begin to matter again. We think the risk-return trade-up is much better in these assets. The market dynamics are set up for some price reversion. In the assets we own for our investors, there's enough of a margin of safety that everything doesn't have to go right for us to realise significant gains. We believe that all of our portfolios are in a position to deliver on their return objectives, all the while ensuring we manage downside risk like we always aim to do.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.